is the Fed pivoting? Is the market going to crash? Stay tuned. Everything I'm going to cover in this week's video, I think you're going to find a lot of use out of it. I'm going to drop timestamps below for different stocks that I'll be covering, so if you want to skip around, feel free to do so. But just to give you an overview, we're going to look at all the indices, what's going on with Apple, Amazon, Microsoft, Google, Meta. We'll also check out Tesla, Rivian, and Chargepoint. A lot of activity there, a lot of money to be made on those trade setups. Then we'll take a look at Royal Caribbean, Coca-Cola, Pepsi, Procter & Gamble, Costco. And then if we have some time, I'll also look at Zoom. I just recently completed a financial model for Zooms, so we can get an idea of what it's actually worth on a per share basis. And then I'll talk a little bit about energy as well as CPI and where I think we're headed in the stock market over the coming weeks. The S&P 500 is down 25% from all-time highs, and so we're technically in a bear market. We've been having these up and down, wild, violent swings that have been hooking a lot of people, either thinking that the bottom is in. If you're Meet Kevin on YouTube, you think the bottom's in, you buy in around here, and then you get dumped on. Probably going to see a lot more of this still as long as the Fed isn't pivoting, which recently has been in the headlines a lot. A lot of people are betting that the Fed is going to reverse course. I'm in the camp that they probably won't until things actually look quite grim in both the economy as well as the stock market. Whichever comes first, I think once we start breaking down below 340, maybe even 320, and depending on how quickly we get there, that could actually cause the Fed to force their hand to reverse some of the policies. So that's something to watch out for. But I wouldn't be trying to time that the Fed is going to pivot or not, especially on like some sort of rally. I would just probably play this upper trend line. We've stayed below it 3 times now, but we could have a capitulation move at some point. So that's like really what I'm looking for before I actually want to play any sort of short-term bounce to the upside. But really, overall, if the Fed continues to step on the brakes for their policies and slow the economy down, then we're still going to see this outpouring of equities over the long run. Earlier in the week, we did have a rally. A lot of people were thinking that Credit Suisse was going to default. It was like peak fear in the headlines. We had this 2-day rally. We failed to continue higher. And really what I was looking at was volatility on the week. So we had these 2 rally days. Even on the 3rd day, we touched here, did a little back test and rallied. But on Thursday, we rejected a bunch of times. I ended up going short on Costco, and so far that's played out really nicely. I think we still have some more room to the downside, but CPI is on Thursday, so there could be some market chop while investors are waiting to see what those results are. We could also front run it, considering that unemployment on Friday was lower than expectations. The economy's still heating up. The Fed doesn't really have much room at the current state of the market to let off the gas there on how quickly they're raising rates. So a lot of traps probably this week. You could probably hold shorts through it. If CPI is lower than expectations, then there's a chance there that the market could rally. So I would just watch out for that. But if CPI is high and over expectations, I would expect the market to sell at the end of the week. So you can make some money there as well. For some key levels from a technical perspective, I would look for 340, as well as there's a level right here that actually might act as support. If we draw on a horizontal line from the peak of this candle, it's right around 358, which is kind of where we bounced before. So looking at that level, we could bounce there again, but ultimately I think this 340 will be a strong support. So you could play the bounce there depending on when we get there. I don't know how long it'll be sustained. It really is going to depend on CPI. And then, of course, during October's monthly OPEX week, which is the 21st, so that whole week up until the 21st, there could be a lot of traps there. We could have a rally as like volatility expires, as a lot of these put contracts from middle of August expire. We might have a momentary relief rally. I probably expect that at some point around that OPEX day, maybe a few days before, even a few days after, we could see a rally there. So I'm looking at all those different levels and just trying to play support and resistances. But I do think November 3rd is when we should have our next rate hike. It's expected to be 75 basis points. So I do expect the market to continue in this downward trend over the longer term. If you're looking out and playing contracts December, January, February, March, you're probably safe on playing puts. So looking at Apple, there was actually some key levels here. If we look here on the hourly chart, you'll see that Apple bounced off of this like 138 area, rallied the first 2 days, and then it rejected a couple times here around 146. And so once I saw this happening, I actually went short the market, and we had that sell. And Friday was a really ugly day, especially with the economic data, so that really just lucked out in our favor. I do think Apple will eventually go lower over time. If I look at my model for Apple on a per share basis, if I look at a base case scenario with some pretty conservative estimates on growth, as well as a conservative discount rate, Apple is overvalued by 22%. So it's still got some room to the downside. If I looked at a downside case, it's almost 32%. It's a 106 valuation. And then on the upside case, if they continue to grow, and I think I used an average over the last 4 or 5 years, 11% for 10 years, and then continued onward, it'd be worth 160. So this is a really it's not a conservative approach at all for the upside. Like a company this large with that market share, it's really hard for it to continue to grow at high rates. And so most likely this base case around like $115 is probably its fair market value. It's just something that I personally wouldn't invest in, not at these prices. So I think Apple has a much more room to fall by the end of this bear market. I wouldn't be surprised if it was trading for double digits. So that's a level that I'm looking for as well. Like right here where it previously broke out in July of 2020, this might act as a support. So let's just like put a level here where it made that gap. It's most likely probably going to fill that gap at some point. Moving on to Amazon. This was kind of interesting. They actually just started laying off some employees, and the same thing is happening with Facebook or Meta. They announced that they might end up laying off about 15% of the workforce. We actually just broke below the March 2020 lows, so expect this to probably come down to that 123 level, which is the low back in December of 2018. You could probably play that level as a bounce. So that's something that I'd be looking for. And of course, if we put in a long position here, this is probably a really good play, either all the way up to 136 or even up to 150, just depending on where the market is during that time. So that's something to watch. Amazon, like I said though, just coming right back to here. This bounced off of that resistance level. We're probably going to travel back down to 108, potentially even down to 102 again, the lows there. This is one that I'm actually building a model on because I'm curious to see, a lot of these well-established businesses, they're not going to go anywhere. So at the end of all of this, there's going to be a lot of opportunities to get in at good prices on these great companies. Same thing with Microsoft. This actually just broke below support, June lows. It broke down below before, and then it had this really strong rally to the upside, trapped a lot of bulls here, then just gapped right back down. I still think tech's still got a ways to go before this is all over, so I would expect, it probably comes down to like 210, even to 191 at some point. Google, this is kind of an interesting one. We were playing this potential move to the downside. We had this little rally and rejection here again, so it's probably likely to start pushing lower again, maybe even down to $91. This is not in a good setup. I wouldn't play this at the moment. And then moving on over to the EV space, this is kind of interesting. Tesla had that, their delivery numbers were worse. Their AI day was pretty trash, and we have all these rejections here on a technical level. We rejected, and then we've been selling. If you played the position here, you would have made some good money down to 232. And then there was a bounce off of that support during the week. If you look on the hourly chart, we did come down, test it, and then we bounced off of it. But then We just sold right back down, especially with the fact that Elon's going to end up having to sell Tesla shares to buy Twitter. So overall in the EV space, it all moves together, right? So I'm also looking at Rivian. They had to recall all of their vehicles outstanding. I think it's like 13 or 14,000. And so that's a cost to the business. Something was wrong with the steering wheel, could potentially lose control of the car. Imagine trying to buy a car that could end up killing you. It's a lot of risk with these newer electric vehicle manufacturers. Looking at Chargepoint, this is in a similar setup. You can see here, if you draw a trend line, it is in a bear flag. And so we're probably gonna have a breakdown at some point. It looks like it actually might be trying to drill this level here. It's probably a good bet with the whole overall market as well as what's happening with Tesla that this will probably break at some point. To get an idea from, its potential price target, taking the highs and lows of the flag, that could be all the way down to $3. I don't think it'll get there in any short time frame, but definitely a good opportunity here to play it short down to this $11 level, even potentially down here to this $9 level over the coming months. So this is a really good position as well, and I would probably look for it to break this level here right around $14. We can enter a short position, have a stop loss in place, and have a target all the way down to $9. This is probably the likely scenario for Chargepoint. Taking a look at Royal Caribbean, we actually did enter puts here again. So we had puts here that Carnival Cruise Lines reported really bad earnings. Royal Caribbean sold on that news, and then we had this huge bounce to the upside. It didn't really sell on Thursday or Friday, but it did reject here around this 44 level, so it could be kind of this back test, retest, and it might dump all the way back down here to 37 and even potentially down to $31. Royal Caribbean does swing a lot relative to the overall market, so this one's a little bit hard to time, and premiums are high, so you really want to try to time this the best that you can. But I do think their earnings on November 4th, there'll probably be some selling into that because Carnival Cruise Lines didn't do well. So if you get out ahead of it, over the next month, I do expect this to probably head lower. And then if you do want to hold through earnings, it's not a bad bet either. So that's something to look out for. A lot has been changing with some of these like older, more stable businesses. So you've had Coca-Cola, Pepsi, Procter and Gamble, Costco. They've had these huge runs, but they haven't really sold yet. And so I think there's this huge rotation out of some of these big names, these blue chips, these well-known companies. And I think you're going to see a move to the downside. I mean, it's already starting to happen. You could play some of these trend lines and see if they break below. It's just something to look out for. You could even play the bounce on some short-dated contracts. You could buy calls on the week if that line gets tested there. Same thing with Coca-Cola, but it actually broke below. So if I was looking at just a longer-term trend line here, it did break below. And then, of course, you could even look at some of these price levels where it's bouncing or rejecting. So like you see here, it came back, retested that, rejected, broke the trend line. It's probably headed back down to this 52 level where it's bounced a few times. This is probably a better one to play to the upside on that. So if you wanted to do like a short dated contract to the upside, you could play it here. Maybe on some weekly calls. And so that's a good position as well. Looking at Procter and Gamble, we've been short. We've actually played it down on this drop and then this drop as well. It had that bounce up, retested this support, which turned into resistance at 150. It rejected, bounced around again a little bit here, and then we're headed lower. I do think it's going to come down to this level around 121, 122, and even potentially down here in this 112 range at some point or another. So that's something that I'm looking out for as well. Costco, still short on this one, making a lot of money. Made a lot of money on this move. Making a lot of money on this move so far. Bought some more puts on this retest here on Thursday. Got a really good entry. It was up 2% on the day. It rejected. The whole market started rolling over. I entered some more puts for January at 440p. And so I do expect that this is going to come down to that 406 level. I think it's going to go down there and test it again. I currently have naked contracts, but probably will try to ghetto spread them at some point by selling the lower strike for the same date, same expiration, and that way I can take some money out but still have a position in place. And so I do think this is going to break at 464. We're probably going to head to this 440 level. You could take profit, but depending on your time frame, I think 400 and even probably lower at some point will trade. The company is good, but price to earnings of 36 for this type of business just seems a little bit too high. Zoom, this was kind of an interesting one. It looks like we're actually going to go and test that $60 level. So that is the all-time low. It's also where it IPO'd, and I do think that that's going to act as a strong support level, and we'll probably have a bounce, maybe 33 to 40% once it hits that level. It could take some time. You got to be patient with these things, but I think maybe a few months out, even a month out, you could just spread some different call contracts. Maybe you could do a 70 call, 65 call, even a 75 to 80 call is possible, just depending on what your time horizon is, as well as where the market is. So if the market's really low, Zoom is really low, and you think the market's going to bounce, it's really good long to buy these companies that have higher betas relative to the market because they'll bounce the most. And so I like to play these on bounces usually when I think the market is at an interim bottom. And then looking at Zoom from like an investment perspective, I did model out 3 different scenarios. And looking at a base case, it's worth $65. So it's kind of fair value. If I looked at a downside case, it's $45, and an upside case around $95, just using different growth rates. It has grown a lot in the past, but I think because of where the economy is going, you'll see some softening. And one last thing, looking at energy, we did have this huge bounce to the upside on oil. And the reason behind that was OPEC is actually cutting production of oil per day. And so you had this huge bounce. We were breaking down below, but most of this move here has actually been manipulated by Biden releasing the strategic petroleum reserves. And so he's been trying to lower the price of gas, and now you're starting to see an uptick in gas, even at the pump, especially over in California. But I think that high gas prices are going to continue to go up, especially with everything that's going on in Europe. You still have the war going on. I think geopolitical tensions are still on the rise, and so overall, I think this will probably continue to the upside. We'll have high oil prices again. We're going to see CPI probably still tick up. Recently, there are some CEOs of food businesses that were talking about their cost inputs were expected to still be high for 2023, and that they're not actually going to be cutting any price. But there are certain parts of the economy that are rolling over. There's high inventory with companies like Nike, for instance, which has been selling off. There's this bullwhip effect that is happening because of how much growth we had over the last 2 years, and now that it's slowing, a lot of these companies didn't prepare for that, and we're ordering and taking in inventory that growth and demand just did not sustain. So they've had this dampening on sales, and now you're seeing this move to the downside. Something that's really interesting as well as real estate. So as you know, the 30-year mortgages is 7.5% roughly for the fixed rate, and so that would raise someone's mortgage about their payment double, and so housing prices are likely to continue to move south. I wouldn't be surprised at some point if this low of 25 on this real estate select sector ETF will at some point test. I would not be surprised at all. You have everything in bonds rolling over as well. Everyone thing is just preparing for a hawkish Fed that's going to continue to raise rates over time, and even now just noticing the investment grade bonds are trading below their COVID lows. So this isn't really a bad thing when bonds are selling at this rate. So at some point something's going to break in the market. Some company is going to default, go under. It's going to happen. I don't know if it's going to be Credit Suisse or not. Probably at some point a bank will be left holding the bag, and it's probably most likely going to be within commercial real estate just because of the higher debt cost. So that's just something to look out for. So a lot of tail risk in the market right now. Something could break at any moment. I think if you're looking to buy long term, you're gonna have to wait and be patient for when things look really bad, and it might even be bad enough to the point where the Fed is pivoting, and maybe they're not lowering rates, they're just stopping rates, but people are gonna think that, oh my god, the market's gonna keep going lower, and that's probably the actual time that you should be buying for the long term. So keep that in mind. Hope you learned something in this video. Probably going to release another video at some point in the middle of this week with a different topic, just focused on one specific subject. But I hope you liked everything here, learned something, and I'll see you next week. Peace.